You're about to listen to a phone call with a guy named David, who's a first-time home buyer and who wants to know how much house he could qualify for and what a monthly payment would look like. He wants to buy a house or a condo in the $600,000 to $700,000 range. Chris walks him through the essentials and explains what David can afford based on his situation. This explanation will be applicable to anyone in a similar situation, even if it's not the exact same numbers, because it will show you how to really figure out how much you could qualify for if you're self-employed. You'll hear more about his specifics, but as a brief overview, David is self-employed, made about $120,000 in take-home pay last year, and has about $85,000 of his own available to put into the house. As a quick disclaimer, my name is Landon, Chris's son, and I'm David in this video, but this conversation is modeled after real conversations we have with real clients, so we can provide privacy to our clients while still offering you a window into real situations. If you want to have a phone call with Chris, go to clevelandstreet.com. I've been renting, and I'm not sure if I want to do a house or a condo. I think I've looked around in the shoreline area, and I've been looking in the $700,000 range. That looks like, I could probably do something below there, but if I could get into something that's $700,000, that'd be great.
Okay.
Based on what I've seen, condo-wise, it seems like there are decent condos that I like the look of. I'm not sure what your thoughts are on condos, but I like the look of that are in about the $600,000 range.
Okay, and that's good that your eye goes to lower price points on condos because, as I'm sure you know, most of them have fairly substantial, especially in that price range, are going to have fairly substantial monthly homeowners association dues. And so your monthly payment on a $700,000 house and a $700,000 condo are going to be very different because of that element of homeowners association dues that could be $400, $500 a month in addition to your other normal real estate taxes, etc. But that's good. So you're in that range, and normally the two main limiting factors. So let's start with credit. Yeah, let's start with credit. As far as you know, how's your overall credit profile?
Yeah, it's pretty. I had some student debt I was paying off.
Okay.
And so I think I'm around 700.
Okay, and where do you get that? Where do you get that notion of a score?
I use Mint. It's like a financial service, and they send me an update of where they think my credit's at. Okay.
And are you aware of any derogatory events in your history, or you just think that's where you are because that's just what your profile has generated? You're not aware of any specific where you've missed a payment or been late or that kind of thing?
No. Yeah, I'm consistent. I've never missed any payments. I just put it on auto pay, but I don't know how it all works, but I think it is the student debt there.
Okay. And while we're on the subject, how much debt do you have right now? What's the balance and what's the monthly payments on any debt that you do have right now?
Yeah, I think I have about $20,000 of debt left, and the monthly payments are in deferment right now.
Okay.
So it looks like that might be coming back around here soon, but right now they're in deferment.
So that's fine. Both Fannie Mae and Freddie Mac, who we're going to underwrite the vast majority of options that you're going to be looking at, probably all of the options you're going to be looking at, both have a basic metric that they use for loans in deferment. One of them uses 0.5% of the balance per month, and the other uses 1% of the balance per month. And so we can take a look at that, see if that's going to be a problem or not. But it should be fine. It should be fine. The fact that you have a perfect credit history is good. Just understand that Mint and all of the consumer-facing sites that aren't mortgage companies, that aren't offering mortgages, don't provide you with an actual mortgage credit score. There are so many different, auto dealerships have their own, credit card companies have their own, department stores have their own. Everybody's got their own models that they use. It could be higher, it could be lower. Yeah, it could be higher, it could be lower. We're going to pull a mortgage score. There'll be 3 scores, and we'll pick the middle one. This is still useful as an indicator. Yeah, this is useful as an indicator, and what's more important is your history, your knowledge of your own history. Everything's been perfect. So good. That's fine so far. One of the things to keep in mind too, I think when we talked before, you mentioned that you haven't owned a home before. You're a first-time home buyer, and for first-time home buyers, who make 100% or less of area median income, actually up to 120% of area median income in these high cost counties like we live in here. You're looking in Shoreline, that's King County, have some fairly favorable pricing metrics in place right now that essentially ignore credit score adjustments for most programs.
Yeah.
And so that's going to work in your favor.
Not really sure, how that's going to work. So I've read some things because I'm actually self-employed, and I've read some things about it seems super confusing. So that's part of why I wanted to just get on the phone. So I may actually make, like, on my end more than, I don't know what the median income is, but I may make more than that. But I'm not sure if that's what's, like, if all of that counts for what you're talking about here. So so basically I own my own painting company.
Okay.
And I'm not sure how it's all used for mortgage, but basically the company in the last year has made about $180,000 in profit.
Okay.
But I take home about 120 of that after 60 in expenses. So I'm not sure if all of that's used, and it's done really well the last year, but the year before that it was a lot. It was we made in our second year. I've been doing it for 3 years now. In our second year we made $100,000, and in our first year I only took home $45,000. We made about $60,000.
Okay. So since you're self-employed, and you're illustrating the challenge with self-employed is that it's hard for you to know how an underwriter is going to look at that. I mean, you mentioned $180K in profit, but then you went on to say you take home $120 after expenses, and so usually profit is after expenses. But what you're saying maybe is $180K in gross revenue and then $60 in expenses.
Yep, sorry.
Okay, no, that makes sense. Nope, that's perfect. So we'll look at your tax returns and figure that out. I do think that first of all, self-employed, you need a minimum of 2 years self-employment income, which you have, and it sounds like you filed 2 years tax returns, because it's not.
Yeah, correct.
Yeah, you may think that if I started in March of, or let's say November of 2021, then then 2023, I've filed the 2021 and 2022 tax return, but of course that first year only has 1 year. In your case, it sounds like you'll have 2 full years, which is great. Yeah, okay. You'll have 2 full years, which is great. And you said 100K, was that profit 100K, or was that before expenses in the second year?
Yeah, that was profit. So first year I profited 45. Total revenue was about 60. Second year I profited 100, and total revenue was about 130.
Okay, and then third year is 180, 120 profit, you say.
Exactly.
And the other slight clarification, doesn't really matter right now, but your take home for a self-employed person doesn't really matter. It might matter in certain type. Most corporations now are either partnerships, LLCs, or S corporations. They're not typically C corporations, which are their own taxable entities, and then you are only taxed on what you take home. But if you have an LLC, which is likely, I assume,
which
then
we do, yeah.
Then really it's just whatever the profit is at the corporate level is what your underwriting income is going to be. Of course, there are ways that we have to calculate that, but it sounds like we would probably take an average of 2 years. So we're taking an average of 120 and 100. That's about 110. And area median income in King County is 125 roughly, and 120% is 150 roughly. So you'll probably benefit from that. And the whole point of that was, obviously we need to know your income when we start having this conversation. That's we're going to get into more detail on that. But the point of that was to say, look, you've got about a 700 credit score, give or take. But we're not too concerned about that, because you're going to be less than 100%, certainly less than 120% of area median income if we take that 2-year average. And that means that your credit score probably won't hurt your pricing too much. You'll have the best available pricing without any negative consequence for having a 700 score versus a 720 or a 740 score. So that's great. So the main limiting factors are credit. I don't think that's going to be a limiting factor for you. And then cash is another big limiting factor for a lot of people. How much, and people tend to think in terms of down payment, but I like to talk to my clients in terms of how much cash do you have available for this entire transaction, because of course the cash that's needed is more than just down payment. It's down payment plus closing cost. And so what's your sense of what's your ideal amount of cash that you have available to put into there? What's the stretch amount of cash that you have available to put in, and what's sort of the minimum amount that you have readily available?
Yeah, so what I've been planning to do, and probably the max I can do, is I guess I've been planning on a down payment. So I don't know how to split it up, but
right.
Everything I have available is about $85,000.
Okay.
For what I'd be comfortable using.
And where's that coming from?
I've got about 20 in stocks right now, and the rest of it's in savings.
Okay. So stock and then savings. Okay, great.
So sorry, Chris, I don't have a ton of time, but I know there's probably some calculations you have to do on your end. So is there anything else you need from me up front, or are you able to get a sense just from info I gave you of, am I in the right? Do you think I could afford what I'm looking at, or?
Yeah, so very high level observations right now. Yeah, we will have to do the math. We'll have to do the math, with where interest rates are, and I think it would be helpful to look at a couple of specific properties. So what I would assign to you is go find a random sample property. It doesn't even have to be one that you would really buy, but it's just in your price range and kind of in the area where you're looking. And find a condo and find a single family in that price range. And the reason I like to be specific about that is because we want to look at debt to income ratios, and sometimes we're getting tight. That's the other limiting factor we didn't really talk about, but that's typically on a conventional loan, you're going to be hard capped at a 50% debt to income ratio. And that's just basically your housing debt plus all other debts, which in your case would be your student loan monthly payments, divided by your gross monthly income. And we're going to be hard capped at 50% on that. So it's just good because real estate taxes vary from house to house. Homeowners dues vary from house to house. It's just good to take something that's real out there and just run some numbers and see how much cushion you have based upon the high end. And this is what I call stress testing your objectives. I like to go to the high end of what you've been looking at because, that's where we're saying, look, you're fine at the high end. You've got room at the high end. You've even got some cushion there. And so anything below that's going to be fine. And that just kind of sets the tone up front. Or if we look at it and say, that's going to be a challenge, so here's where you're going to have to adjust, or here's some things to look at or be concerned about. So it's just good to start there. And
right.
And then I also like to get at least 1 year of your tax returns, an actual tax return. If you have a separate business return and a personal return, I need both. If you file it all on your personal return, just that one. And the reason for that is because so many people, the taxes are complicated, and then figuring out how lenders translate that to their underwriting guidelines is just another layer of complexity that you just don't have a window into. So I like to get a good look at that to say, okay, this is where, and I'm a CPA, and so that also I'm also very good with taking those and translating those for the underwriters. So let me take a look at least 1 year of tax returns, personal and business if you have both, so that I can validate the income. And if I look at it and 120 looks about right for the most recent year, then I'm going to be good with the others. Of course, we would want everything in order to issue real pre-approval letters, but for this pre-qual conversation, we'll feel very confident.
Okay, great, got it. So I will, there's a couple places I can kind of think of right now. Do you want me to just send you a Zillow link for those? You can.
Yeah, no, that'd be awesome. Yep, just send me a Zillow link or an address, whatever works for you, and I'll run some numbers, and we'll have a preliminary conversation about that. Well, hey, David, it's Chris. Just want to let you know, thanks for sending that property to look at, the single family home there in Shoreline, 725. And I ran the numbers and I went with 10% down. You mentioned, the price was 725 and you mentioned having about 85 comfortable. So if we go 10% down, that's 75 plus your closing costs. There's enough to cover. That particular house, the listing agent was posting a $10,000 seller credit. So that certainly helped your cash to close. But when I ran the numbers, I grabbed the real property taxes and everything, 10% down, we ended up with a debt to income ratio that was about 55. And I think we talked a little bit about the fact that you're going to have a hard cap at 50. And so that property would probably be a little bit out of reach. Now, I would like to get your tax returns and verify this. I didn't see those yet. And maybe, if there's more income, we might be able to get stretched to that level. But that's probably going to be just a little north. Now, sometimes also, when you run this through electronic underwriting, sometimes it'll only require 1 year's tax return. And if that's the case, that would help as well, because right now we're averaging your 2 years. But right now, I ran the numbers down to 650 with 10% down, and that gets you under the 50% debt to income ratio based upon what rates are doing today. And that is really just a general number. That shouldn't be viewed as a hard cap, because of course in this situation that would only use up about $70,000 or $75,000 of your 85 available, and so you'd have more cash to put down if you found something a little bit more than this. And then of course it depends on whether the particular property taxes and what are rates doing that day. So my recommendation is, you're in the ballpark. It's not like you're dreaming of something that's way beyond your reach. You're in the ballpark. My next step recommendation is, let's get your real tax returns both years. And then if you start to look at that and say, if I found something at 650 that would work, then I would recommend that we go ahead and pull your credit and run you through the full formal pre-approval process. Get your tax returns, work out real numbers, run it through and confirm kind of what's the max that we can qualify for. Because if you looked at it and said, 650, there's just nothing out there right now that excites me at 650, then I would say let's wait a little bit. We can still watch the market. We can still run numbers anytime. But if 650, you look around and think, oh, there's things out there. Now we're talking about single families, not condos. We haven't looked at a specific condo yet. But remember, those are typically going to have higher payments for the same price point as a single family because of the significant HOA dues that are going to be a part of that. So overall, I think the good news is that you weren't too far off. Yeah, and I asked you to stretch, and that's what we were doing. We were stress testing your objectives, and near the top, we're probably not quite there, but we want to confirm that with the real data, and then have you look back at the market when we have that and see what's out there that gets you excited. Thanks again for the opportunity, and I look forward to speaking with you again soon. Bye-bye.